You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Hello, everybody, and welcome to another exciting edition of Talking Real Money, where we bust financial myths faster than Zeus tossing a lightning bolt.
I think something a little more recent in terms of analogies.
Because we're talking about myths. You see, Greek and Roman mythology.
Okay, that works. Okay,
the world of investing has got all these stories that have been passed down. These myths.
I thought it would be something more like sooner than Tom tells another bad joke or something.
Well, I tried to beat you to the bad joke punch.
Okay,
with a stupid illusion.
That was good.
These myths are stories that are rarely rooted in reality. They're sort of loosely
rooted in reality.
Really rooted in reality. And get this, you ready?
Yeah.
Financial fables, though, they're harmful. They can actually cost you money. So that's why when I saw this article from our friends at Kiplinger about 5 money myths, I thought this is something we need to talk about, because we need to be like the show on reality television, whatever network it was on, financial or alliteratively.
Yep. Okay.
Money Mythbusters.
Money Mythbusters this hour. Sure. Why not?
I can't talk anymore.
That's going to be a problem, by the way.
You take over from here.
I ain't going there either. So, all right. So I'll read them, and then you can tell me.
And I'll weep. You read them, I'll weep.
Truth or false. This was pretty fascinating, actually. Paying off a 5% mortgage is equivalent to buying a 5% annual return investment.
Yeah, this one fascinates me.
It really does,
because it's actually true.
It is.
But it's true in a kind of a roundabout way. You see, you're paying basically 5% on your money all the way through, and this is where I kind of disagree with it a little bit.
Yep.
But the problem is in the early years, the interest on the mortgage is so large because you haven't paid down much of the principal. As you pay down the principal, your interest rate declines because you're not paying interest on as much money. So the older the mortgage is, the less sense it makes to pay it off, the less financial impact it is going to have on you. And generally speaking, when you have a mortgage, you have it because you can't afford to pay the full amount for the property, and you have to borrow the money. And sometimes later on, you've got the money, but its financial impact won't be as great. And the other thing is real estate lacks liquidity.
Yeah, and we've discussed that many times. We'll continue to discuss it because I think it's a bigger situation today. By the way, I find it fascinating they came up with 5%. You know, it's 3/4 of mortgages are now under 5% in interest. 3/4. I mean, that's a big.
Well, but those have got to be leftovers
from 2020, right?
Yeah. From back when.
Mine's
not
bigger
our day. You don't have a good rate anymore.
No, I don't. I have a lousy rate. Yeah, I'm praying that all of this means that interest rates are going to decline.
Don't count on that.
I wouldn't count on it either.
No.
I'm with you.
I think the Fed. Talking interest rates. I don't think the Fed is going to be particularly aggressive in cutting rates because of the inflationary pressures that tariffs provide.
And just a general confusion about what direction the economy's headed. Nobody seems to know, up, down, sideways.
People hate confusion.
Yeah. But this is the problem with this is it's mislabeled. In other words, there's a whole other raft of things you consider before paying off the mortgage, because you mentioned something that most people do not consider, and that is liquidity. People have, in cases, $1 million plus of home equity that they may or may not be able to get at, and they may or may not need. So I think
Right.
that's a bigger question.
Right.
So
Right.
that's a good
There's
one.
a lot of money. As
Yeah.
a matter of fact, I think I read
It's $35 trillion.
$35 trillion
real money.
is just locked up
Yeah.
in homes, and it really is locked up. It's not easy to turn a house.
I do have a nice condo that you could get into in Kirkland.
Which isn't easy to turn. And condos are even harder to turn.
Don't get me going. I brought it up in the office. Somebody said that condo's been tormenting you for almost 20 years.
Oh, forever.
I know. All right. Number 2, doing a Roth conversion from a traditional IRA reduces taxes and saves money.
That is definitely it's, again, like the myths of old, it is a myth wrapped in a thin veneer of reality, because there are times when doing a Roth conversion from a traditional IRA can reduce your taxes and save you money.
But
it is not an absolute.
Thank you, because most people walk in the door here and say, great, I'm going to do all these Roth conversions. And I say, maybe. It's not automatic.
Unless you have a Mount Olympia-sized mound of money at your disposal.
Good point. Yeah.
To pay the taxes on those hundreds of thousands of dollars, or in some people's cases, millions of dollars they put away in IRAs and 401ks, then right off the bat, it isn't worth doing. If you don't have the money with which to
do
pay
not
the
take
taxes
it out of the
elsewhere,
account. I agree.
Do not ever do it. But here's the problem. Sometimes some people in some situations might end up in a worse situation in the future, tax-wise. So you never know which way to go. You're predicting the future that is an unpredictable future.
We don't know future tax rates.
We don't know the future tax rate.
We don't know your future tax. You don't know where you're going to be.
For example, let's say you convert your Roth IRA today with the top rate being at 30. What is the top rate? 36.
A lot.
It's up there. A lot.
Yeah.
But the top rate goes down to 22, and you convert today at 36.
And you just messed up.
You didn't save anything.
Yep.
If it goes the other way, you did really well.
Yep.
If your income goes down in the future, then the Roth is not going to be of benefit to you, and the traditional would have been of more benefit. So there's a lot of moving pieces and parts in here. So it is not an absolute. You need to have, shall we sound like a broken record?
It starts with the
P word.
That's it. Yeah, plan. And you need to probably run this year by year. I think for our clients, every year we run it because every year is a little different. So, but it's not automatic.
It's still guessing. You're still even.
I will add one thing to that, though. If you're a young person and you're in a low tax bracket, it is an absolute 100% no brainer to be putting all that money into Roth.
Yeah, and when you're an old guy like me and finally gotten to the point where you get paid what you're worth.
Wait, you're getting paid by the government what you're worth.
Well, now, then you
we
want
haven't even talked about that on the show yet.
Pre-tax thing. You want that.
We haven't even brought up the fact that, this comes with number 3.
Oh, look at that.
Yeah, timing. Social Security is going bankrupt or becoming insolvent, and I don't expect to collect any benefits.
This is why I filed early.
Come on. He did file, but not a few months, by the way.
I filed a year early.
Okay.
I did. I filed I
and
asked
how
for
did it go? Did you get your money?
I asked for my Social Security a year early because I did the math and my break even was 84. And I went, while I would like 84? To live past 84, I don't know. So let's go for the bird in the hand right now and but try to enjoy it while I'm still healthy enough to do it.
To the experience, you went online, you filed.
I went online.
And they sent you the money.
Yeah, I went online and I filed in March.
Wait, like last month, March?
Yeah.
What?
Yeah.
I thought.
No, I filed in February. I filed the end of February.
February 2025, not February 2024. Because everything you read says it's going to take you forever. You're never going to see your money. Nobody's going to help you.
Yeah, because of all this, I figured it was going to take months. That this, that was what you're hearing, that everybody's been laid off.
And you're able to do it all online?
I did it all online. Did it all online. It was really, really easy. I went to Social Security, SSA.gov.
Yep.
And I did it online. And I got a notice from the IRS saying, it's been sent to our Birmingham, Alabama office for approval and consideration, and it could take a while. And so I waited and wasn't in any big hurry. And one day I got an email that said your Social Security has been approved, and I went, oh, that's nice, and I just later that day happened to go into my Bank of America account, and there's my Social Security.
Wait, they just sent it like that right into your bank?
They just sent me the money. Now, immediately, I put all of that into savings going because I'm now going to get taxed on that.
Yep. How about that? Yeah.
But I got the money. It was like, wow.
So, but that was like less than 2 months.
Yes, it was less than 2 months.
Okay. You know what else they're really good at online?
Quite a bit less.
Paying them. I just didn't know. I just sent them a lot of money.
Well, that wasn't Social Security. That was the IRS.
That was the IRS, but their website works rather well. I made the
it'll
payment
take
in about
money.
40 seconds.
I was just worried about it giving out money.
So
but apparently it works both ways.
Is this kind of like one of those, like buying a home, like American Dream kind of things? You're getting your money back from Social Security?
I know. I'm so shocked. And it's so weird because I didn't really, I mean, I don't need it. But it feels good to have that extra money going into the account. It does feel good.
Do they pay you every month?
Yeah, and it feels particularly good in when you even I know I've been doing this for a long time, but even I can feel the twinges of anxiety related to the economics of the country and the world right now.
Can't help yourself.
So seeing that extra money is kind of like,
sure.
Okay. You know, I knew and you know what? I've always believed in being honest with all of you on this show. I know that I've said wait till 70, but at 69, I was just doing the math and I went, I just think I'm going to do it. Yeah. I want to enjoy it. That's another, $50,000.
Sure.
That I can enjoy if I want to this year. I can.
Yeah. By the way, I have an opportunity.
Go take a Tom Cox style vacation.
Nope. I have an investment property opportunity for you right out here.
No, I'm not buying the condo.
Oh, God damn it! Okay, I was trying. It's going to be easy.
All right. So Social Security, is it going bankrupt or becoming insolvent? And I shouldn't collect any.
No.
I did collect benefits.
Yeah.
And remember, Social Security is.
Oh, that's right. We're supposed to talk about the point.
Yeah, it's a pay-as-you-go thing.
Yeah,
I mean,
money comes in, money goes out.
Money comes in, money goes out. Now, what happened though? The surplus that the Social Security Administration
baby boomers were paying
carried for very, very many years is dwindling because there are.
You filed early. That's why
baby boomers didn't make enough babies. And baby boomers' babies aren't making
You were good in that area. So.
Yeah, well, somebody's not holding up their end of the bargain.
As it were.
Either that or our rotten children aren't making enough.
That's a different situation.
Could be. Yeah. Although your kids, they're doing their part. They're making a couple of bucks, particularly your son.
Yeah. Anyway, so that would not be a reason to change your Social Security strategy, which should be a strategy. No, 100% not.
Current greed, different story entirely.
I kind of like what you said. I want the money. I don't know how long I'm going to live. Why not? I'm waiting until 70. I've said this before.
That's what I said.
I know. True.
And then when 69, I'm looking at 69, just going,
give me my money.
It's only a year.
Give me my money. Yeah. Anyway. All right. Number 4. This one we have discussed fairly regularly.
Yeah.
Seems like it comes up all the time.
Yeah.
Withdrawing 4% of your retirement savings ensures that you won't run out of money before you die.
The critical word in that sentence is ensures.
I tried to emphasize that.
Nothing, and I did a great job emphasizing that too.
Thank you.
Nothing is insured. We cannot say the word, despite the fact that Tom does once in a while, we cannot say the word guarantee anything.
We can't guarantee.
We can't be certain that anything in the future is going to happen. Now, having said all of that, the 4% rule has been tested under various hypothetical scenarios and past scenarios. You can always back test based on the past. We know those numbers. You can also guesstimate the futures and test it using what are called Monte Carlo simulations, which kind of spin the roulette wheel all the time.
Yep.
And you figure out what the worst case scenario is. And if you look at almost anything short of the total collapse of Western society,
which you're not going to care about money.
Right. The 4% rule holds up really well. Really, really well. And that means taking 4% of your money every year and then adjusting it up for inflation.
And, here's the part you left out. Money needs to be properly invested. Got to have some in riskier asset. You got to have some growth on it to think it through. It's pretty rational. So it has worked.
We have run returns with scenarios in which you had all of your money in fixed income. And if you did that, the 4% rule did not hold up well.
No.
If you had all of your money in stocks and we had a protracted decline in the market, it didn't work very well. But in almost every scenario, no matter how good or bad the assumptions going forward were, 4% worked pretty well if you had a mix of stocks and bonds, or would have worked pretty well.
And the reason that we can't insure anything is nobody knows the future. Part two is your returns are idiosyncratic. I mean, because when they start and when they end is variable. There isn't, we can't just say started in 1970, ends in 2010. I also happen to agree, and I've stolen this quote previously from the great Christine Benz. And Christine, if you're listening, please come on the show. We're going to talk about your book, but she decided not to do it. Must have listened to a podcast.
You made her
or two.
mad.
I guess so. She says, and I think this is right, the only correct withdrawal rate we'll know is after we're dead. Then you'll know if
that was the right amount.
Turned out, it worked out well. So that's why, by the way, I think you mentioned something about this earlier. You should have a plan because you look at all those things in the plan.
Again, but that actually gets looked at in a good plan. That should be looked at. What's the best portfolio construction? And then what does it look like under varying withdrawal scenarios? One that we often use and we find really works well with human nature is the 5% flexible, where you can take a little more out initially, but you never take out more than 5% of the portfolio value, which means after a down year, you're going to be taking out less money. But after
wild
a great
waves
year,
this year,
after a great year, you get my 40, however many thousands of dollars a year I get from Social Security, the extra bonus.
Yeah. All right. Fair enough. All right. One more. We've got time for one more. And this is timely.
This is a podcast. We don't have to fit into a radio clock.
Thank you. This is very timely. It's better to get a tax refund than owe taxes to the IRS. That's easy.
Yeah, which means basically for most people, that means over withholding.
Which is that smart or dumb?
Instead of taking 1 or 2 or 3 exemptions, you take 0 exemptions.
People think it's free money.
And all the money then goes into it gets sent to the IRS, and then when you file your tax return, you get that exciting refund from the IRS.
People think it's free money. It's free money to them, not to you.
It's free loss. Yes, you just lent the government thousands of dollars interest free.
That doesn't make
when you could have put
sense.
it in a treasury bill and gotten 4.5% from the government.
Yeah.
So, no. What you need to do is try to plan every year for what your tax bill is going to be. Do a little tax prep as part of your tax plan, and try not to put in more, or at least much more, than what your tax bill, or you're pretty sure your tax bill is going to be.
Part, right? Yeah.
Yeah, you got to do some. You got to do some guessing and math, but for most wage earners, that's pretty easy.
Yeah.
Because there are tax tables.
Can I mention a couple of the other common myths that I hear a lot? Do you got time?
This is only 5. I'm sorry, but
don't do it.
We can only do 5.
Okay.
No, all right, we can do. How many do you have?
I have 3.
Jeez.
All right. Well, these will be quick.
Okay.
Number 1 myth. I hear this all the time.
We have to change the title now to the 8 myths.
You can figure out how to do all that stuff. Because I just heard this recently at a chat I did for a group of people. Number 1 myth
on Signal. Was the Secretary of Defense there?
He was relaying everything straight to China.
Was a reporter from the Atlantic there?
For God's sakes. Number 1, I can save later.
Yeah, that's one.
People say that all the time. We all start doing that later. I'm only 40.
I'll just put away more later.
Yeah. Mm-hmm. Yeah. Never happens. Number 2, investing is a zero-sum game.
Yeah, no, that's one that's absolutely false.
Well, it's true if you're trading.
That's not investing. That's why I say
I know, but if you're trading, then you're right, win or lose. Yeah.
If you properly...
Correct. Thank you.
If you properly defined the term investing.
Good point.
Gamblers like to call what they're doing investing. Oh, I'm investing in the NBA Finals. Oh, I'm investing in the Super Bowl. No, you're gambling.
Not only just the Super Bowl, the prop bets in the Super Bowl.
Yeah.
Drives me nuts. All right, number 3. This one's one of my faves. Absolutely favorites. I pay my mutual fund more because they make me more.
Oh, yeah, you get what you pay for? That's that old argument
exactly.
that we used to use.
I don't want to use those index funds.
We used to use that when I was a broker.
I'm sure
tell people that they get what they pay for. If they go to Vanguard, what are they going to get? They're just going to get an index.
Yeah.
Well, it turns out they got more than they paid for, than they would have gotten if they'd paid for it. Yeah.
You got to keep saying you're winding an interesting journey there.
Oh, I get distracted. I just got a text.
Yeah. This is the show. You could take an hour out of your week and not get a text if you don't mind.
It's a bloody scam.
Oh, no.
It's like, ready? Are you working today? That's all. It has a phone number.
I got one on LinkedIn.
And of course, this is somebody in Nigeria or something.
Yeah.
And who's going to pretend to be a girl who's like, it was an accidental. Yeah, I know. It's just,
I understand you're getting your Social Security now.
Yeah. Oh, Don, I just heard you got your Social Security.
Guess what?
Are you lonely tonight?
You're getting the money, but that's all you're getting. All right. Let's do a few questions. This one's, I think we've answered something from this before because I remember the place, Mechanicsville, Maryland.
Yes, we have. Unless there are multiple listeners.
Yeah, might be in Mechanicsville.
I don't know
How big a place
that well.
Right. Okay, you're gonna have to listen to this, and you're gonna probably know it. I hope. I started Social Security.
See now, folks, I do not get these in advance. Tom does not let me see them. This is like stump the host. Okay, go ahead. I'm going to have to do some real-time research.
He was a short fellow, right? Stump the host, kind of a short kind of guy.
That really is rude.
I'm sorry. Let's see. I started Social Security at full retirement age, and after 3 months, changed my mind and paid it back.
Yeah.
They cashed the check on December 26, 2024, but it didn't record in the system till 2025. The 1099 shows payments received in 2024 with no payback. I contacted Social Security. They provided a printout showing they processed the check in 2025. I showed them the date the check was cashed, and they said there's nothing they can do about it. The problem is I'm in a higher tax bracket in 2024 versus 2025. Any advice? No, I don't.
Hold on.
I fought the law, and the law won.
I'm thinking.
Isn't there a thing can't fight City Hall or something? I don't know. I don't know really what to tell you because sounds like you're just.
Hold on.
You know what?
Wow.
Somebody at Social Security should be able to go back and fix that, but that's.
Wow. I don't know. Honestly, I do not know. This has never come up.
Nope. Never heard of it in my life.
Never heard of it. I think. Yeah, when did he say he did it?
2024 was him taking the money, paying it back. 2025
but when did he file the form to stop Social Security benefits?
Doesn't give that. He just says they cashed the check December 26, 2024, but didn't record it in the system till 2025. Apparently they took the week off at Social Security. So
my understand, and I'm guessing on this, because I'm trying to think back to when this has come up. I know it. Yeah, and you're okay. Wait, it's a 12-month period. Well,
no, but what he's saying is they're showing him not paying it back in tax year 2024.
I know, but here's what he should, because you have a 12-month period to suspend.
To give the money back. There's no argument there.
No, but what I'm saying is he could. Wow. See, now it becomes an IRS question. more than
Yeah.
a Social
It's a
Security
good point,
question.
by the way. Yeah, she'd go to the IRS and
So
give them the data.
This is an
That's
IRS question, because I'm thinking that any taxes you paid that you didn't owe, you could get returned when you do your 2025 return. That seems logical to me.
That does
because
seem logical.
You
yeah.
have a 12-month window, if I remember correctly.
No, you have 12 months to pay it back. Yes.
Yeah, to cancel it and pay it back.
Yep, that's right.
So you shouldn't have to pay taxes. Oh, you know what? Because you got the it seems to me that he should be able to.
The expert.
No, I'm not a tax expert.
I know.
And I'm really not.
time.
So this is CPA time. No, this isn't even IRS time. This is merely CPA time.
Hand it to
this is
somebody
when
who
you
can
go to
check
your
it out.
accountant and you
Yeah.
say, okay, what should I
Enrolled
do?
agent.
My guess is that you just won't report the Social Security income for 2024.
That would be the most likely.
I think that's the most
Even though
likely
he has a
scenario.
1099, just put a line through it and don't report it.
Yeah, exactly.
Yep.
Don't report it.
That's good.
because when the IRS, if they come back at you and say you didn't report it, then you can say, here is my form that I returned the money within the 12 months.
And here's the cash check, et cetera, see the date on it. Yep.
They're gonna yeah, that's what I would do.
See Don
but I
for
would
all
talk to
tax
a CPA.
disputes because
CPA.
he's good at that kind of thing, right?
CPA.
All right. Time for one more quick one. Yeah.
Yeah. What the
Okay.
heck?
Jim from the Woodlands, Texas writes,
That's
you please...
near Houston. I've been there.
Oh, okay.
They
Thank
got
you.
flooded in that big flood.
Oh,
in the
did they?
Woodlands. It was bad. Yeah.
Can you please suggest a good municipal bond fund exchange traded fund for a high tax bracket individual? My mom is 102 years old and lives in Ohio.
Oh.
I'm considering moving some of her money that's currently in several one-year CDs into muni bonds as the various CDs mature. She's in a painfully high marginal tax bracket, and I don't see any other options to optimize her tax exposure. I don't want to increase her equity exposure above its current 40%. Enjoy the show. Many thanks for your guidance. How about
this is easy.
VTEB?
I was just going to say VTEB.
Because that's an intermediate term muni bond fund, right?
Well, it's a bond market fund, which means it's going to end up with a 5 to 6 year average duration.
Paying 4% or something,
3.6.
Yeah, okay.
Which
That's
is
what I would do.
tax free.
Well,
and it's got an expense ratio of tiny little 0.03%
3 basis points, as you might call it.
3 basis points.
Yeah. Cheap. Jim, I think that's a good solution for your mom. That's nice of you to
VTEB.
take care of her.
That was easy. Oh, this is so much fun. Here, the average expense ratio of similar municipal bond funds, just for comparison.
Wait, don't tell me.
Yeah.
26 basis points.
You're not even close.
Usually I'm pretty good at this kind of thing.
You're not on this one.
Yeah.
Because they think that municipal bond funds are more work because sometimes you particularly actively manage
it's a
ones.
different market than just owning
So
taxable bonds.
You want to change your guess?
Okay, you disturb me. 44 basis points.
Jeez, you're still off. Okay. 67
Oh,
basis
that
points.
is so outrageous in
That's
this interest
the
rate
average.
environment. Yeah, right. So some people are paying more than one. That's crazy.
Mm-hmm.
No. VTEB, very good fund. Lots of bonds. As you said, decent exposure.
It's
so
pretty much the whole market for
that's
investment
fine.
grade.
Yeah,
Yeah.
it'd be great. Yeah. So there you go.
So
That's
the total
it.
bond market.
That's all I got.
All right. You want to add anything?
I always want to add things. I just got to figure out what that would be.
No. Okay. Keep listening. Keep spreading the word.
Send us questions. Ask for help if you want to. You can
Call
go to
us
the website
on
for all that.
Saturday afternoons.
Oh, yeah, please do. Yeah.
Between 3 p.m. and 5 p.m. Eastern time when we do a live show almost every Saturday. I think in the past several years we've taken one off.
I think it was like in the last 15 years there was one Saturday.
We took a
missed.
Christmas, and it was Christmas Day. We went.
We'd be wanting the whole day.
Yeah, we will be wanting the whole day off. And I assume you'll want an extra.
We got paid though too, so
extra chunk of coal for the fire there,
we're okay. Yeah,
Mr.
So please
Graduate.
take advantage of all the stuff we do. That will
Go to
help you.
talkingrealmoney.com because that's where we have all the stuff that is related to us doing this thing where we are pretty much every day talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?